way I'm kind of analyzing it in terms of, if you go back to the 1940s, you had these huge inflationary spikes, but then when the inflationary spikes were done, you had these plateaus where there's now permanently more money in the system, and the aggregate price level is now permanently higher. That doesn't mean that there can't be pockets of things that might have gone down. I mean, if the government needed a ton of copper for the war, and then copper spikes, and then they don't need that copper anymore, you could get a collapse in copper prices, for example. That's like one specific thing, but the aggregate price level is higher. And so the way I've been phrasing it in this environment is like, Chipotle did price increases and wage increases, and those are never coming back down. Everything is priced higher now, or at least most things. So I think, and then it would come down to, the only thing that would make it keep going up is if there was like some sort of ongoing, like if people lost faith, if they're like, oh, they're just going to do it again, and then say the entire international community wants to sell that currency, because they're like, what's from stopping them from doing it again, right? So you could get some sort of non-linear confidence sea change for international demand for that currency that could cause a more persistent inflationary pressure. But as kind of a localized thought experiment, I'd go more with that one-time plateau, higher prices.
Well, a recession in the U.S. is anything that the National Bureau of Economic Research deems to be a recession. So this is a group that is comprised of a number of academics from both sides of the political aisle. They're generally nonpartisan. I don't think that they would try to define a recession in a way that favors one party or another. The reality right now is that some measures of economic activity are pointing to a recession, others are not. And in particular, the labor market, which often weakens during recession, has not yet begun to weaken. There has never been a recession in U.S. history where the unemployment rate has not risen. Well, so far it hasn't risen. So I think right now it is fair to say that we're not in a recession, but we are getting awfully close to one. The process could last well over a year, so you wouldn't expect a verdict in real time. And that's partly because the data gets revised. Like we estimate based on our calculations, there's actually a 35% chance that Q2 real GDP growth will eventually be revised into positive territory. In fact, if you look at Q1 growth, which was also negative, while other measures of economic activity, such as gross domestic income, which conceptually should equal gross domestic product, gross domestic income actually rose by 1.8% in Q1. So it's possible that GDP for Q1 will also be revised to show positive growth.
I think as you look around the world, I struggle to see how Europe avoids a recession. Europe is already in a recession. China, for all intents and purposes, is as well. The combination of continued zero COVID policies plus this real estate slowdown is a tough 1-2 punch. And that leaves the US as a sort of, the big question mark as to whether you get the recession or not. I think the case for recession is a pretty simple one. You have rising interest rates, you have rising price of gas, you have a stretched consumer,
rising
cost of capital. You're already starting to see sort of anecdotal evidence of the U.S. consumer retrenching.
Well, the R&D in the pharmaceutical industry is basically the redeeming feature of the American pharmaceutical industry. You get rid of the R&D, and they're just pumping out whatever they have available. It's just more Tylenol. Okay, well, Tylenol might be slightly cheaper than it was before, but it's not going to lead to the sorts of medical breakthroughs that you need in order to fight disease. The product of a deal announced by Manchin and Chuck Schumer, and it would reduce the federal deficit by about $300 billion, supposedly, by raising taxes. Now, again, raising taxes in the middle of a stagnating economy is one of the dumbest things you can do. And blowing a bunch of money into that economy in the middle of an inflationary cycle is also one of the dumbest things you can do. Senator Mitch McConnell had said he would never support as long as Democrats continued their efforts to push through their marquee domestic policy bill over GOP opposition. That legislation still needs to clear the House. Republican leaders in that chamber said they would instruct their ranks to oppose it after news of the deal. So the idea that from McConnell was, we'll sign off on the semiconductor bill with all the poor, as long as you don't ram through a second bill. Fight back against that. The problem for McConnell, of course, is that he doesn't actually control a majority of the Senate.
I would be surprised if the NBR were to deem this period a recession unless the unemployment rate starts rising. And what could be surprising this time around is that it takes a while for the unemployment rate to rise, because right now you've got these large number of job openings. There's about 1.9 job openings for every unemployed worker. So even those firms that start laying off workers, the people who lose their jobs in many cases are just going to be able to go right across the street and find a new job. So I don't think we're going to see an increase in the unemployment rate probably this year, in which case it may be the case that the recession doesn't start this year. In particular, if you look at consumers, they're still spending despite the fact that real wages are shrinking. Now, it's quite possible, in fact, quite likely, that inflation will come down over the next 12 months. Maybe it doesn't go from 9 to 2%, but it probably will go from 9 to at least 4%. If that were to happen, then real wages, rather than shrinking, are going to start rising. That will boost consumer confidence.
If you have access to cheap capital, that's a reasonable trade to do going out, for the rest of the year. And I think that betting on kind of a top in rates is probably a decent move. And that can be reflected in a number of positions. There's obviously some riskier ones to do and ones not. So what we saw so far this year is, for example, stock multiples, earnings multiples on stocks have compressed pretty significantly, as you've seen an unusually strong spike in rates. You've seen a sell-off in bonds, sell-off in stocks. And the question going forward is, okay, if rates are topping out, maybe the valuation pressure is done now on some of those companies, but then the question becomes what's going to happen to their earnings side if we do encounter either a recession or some type of near recession type of environment. And so, I think there's certainly a way to play at top in rates. It could be a bounce in gold. It could be a drop in the dollar. It could.
Well, I don't think we're going to have rapid growth anytime soon, because the unemployment rate is very low. And so the supply side of the economy is constrained by increases in labor supply and productivity growth, neither of which are going to increase very much. I think as we get into next year, it'll become pretty clear that the economy is just too healthy to require rate cuts, which is what the market currently is pricing in. And that actually could be a headwind for equities. I think the US needs interest rates of around 3 or 4%. The market thinks the Fed is going to bring rates to around 3.5 and then drop them down to 2.5. That would be only true if the equilibrium rate of interest.
And I think speaks to the shift in the global macro environment, the structural shift away from a deflationary world to an inflationary world. So that I think the first realization, if you're an investor deploying your capital, is to know that A, you're in a bear market, and as long as you're in a bear market, making money is tough. I think Americans understand this well because your main sport is American football, and you have a defensive team or an offensive team. When you're in a bear market, you put the defensive team on the pitch, and you're on the field, and you're just trying to not get scored on more than trying to put up points. So first things first, we're in a bear market. Therefore, you need to be defensive.
And the press secretary to the White House explaining that quote-unquote gender-affirming healthcare is actually a form of true healthcare for small children. You have to gender transition small children. Like, if you're talking about policy extremism, forget about attitudinal extremism. Policy extremism, the Democratic Party, one of the weird gaps that's happening right now is that the Republican Party seems attitudinally extreme, but its actual policies are quite moderate. The Democratic Party tries to promote the idea that it is attitudinally moderate while promoting extraordinarily extreme policies. When Donald Trump was in power, his policies were actually fairly moderate, but his rhetoric was sort of wild. And so Americans paid attention to that. When you're not in power, people don't pay attention to either your policy or your rhetoric. So trying to focus attention on the fact that there are some Republicans who say crazy things, that is not likely to bear fruit for a party that is currently in power in all elected branches of the federal government and is ramming through bills that are going to increase inflation and continue to stagnate the economy. Nonetheless, according to CNN, seized by genuine panic about the prospect of Republicans winning control of Congress and governors' mansions across the country, multiple Democratic leaders and candidates in some of the tightest races are calling on party leaders, including Joe Biden, to focus on calling out Republicans as extremists. Well,
stocks and real estate and bonds and everything was super high relative to GDP. And so that's a quite financialized situation, because if you have a big contraction in asset prices, you're going to get a number of factors. One is you're going to get, the top 10% or so are the biggest consumers And if if their net worth is evaporating, they're not going to, they're not on the margin. They're not going to be, putting pedal to the metal in terms of things they want to buy. And then also you're likely to get more turbulence in tax receipts. Generally, there's a very strong correlation between the stock market in year-over-year terms and tax receipts in year-over-year terms. And so in general, I think that the market is very financialized. Inflation for people is different than deflation. It just means that the rate of inflation is going down. And one thing I've been emphasizing for a while is that even though I think this is an inflationary decade, that most inflationary decades have periods of disinflation within an inflationary decade. It could be for any number of reasons. Maybe, in some cases it could be because the supply side issues is getting temporarily addressed. Sometimes it's because the Fed or other central banks are fighting back and trying to curtail the demand side, which is what we're mostly seeing right now. And so I think what we're seeing right now is basically an attempt to hold the beach ball underwater in terms of inflation.
A lot depends on how quickly inflation falls. Certainly some of the supply side bottlenecks that have lifted inflation will dissipate over time, and that'll help reduce inflation. I think the Fed's primary goal is to bring down inflation to its statutory target of 2%. Now, of course, the Fed doesn't want to induce a recession in doing this, but if that's the price that has to be paid, that's the price that the Fed will pay. In practice, it is difficult to engineer soft landings. In fact, there hasn't been a case ever in the United States where the unemployment rate has risen by more than 1/3 of a percentage point without a recession ensuing. I think just wait and see how the economy responds.
The single most important thing today is, the world is facing an energy crisis, and economic activity at the end of the day is energy transformed. Now, this energy crisis is centered in Europe. The U.S. or North America is energy self-sufficient, so America isn't really going to have energy problems. China isn't going to have energy problems because they've turned back to coal massively. Plus, they're buying cheap energy from Russia. So, China and the rest of Asia is going to be broadly fine. The big question mark is Europe. So the real black hole in the world is not the U.S. I don't think it's China either. The real black hole really is Europe. The one way Europe could end up being deflationary is all of this would trigger a further collapse in the euro. I mean, the euro, if it's not in a free fall, it's starting to approach one. And if you run out of energy, then you move into full free fall, which incidentally would further fuel Europe's domestic inflation rates. So, no, Europe, I think, is an extremely dangerous place to have capital deployed today.
Having an existential threat is not the worst thing in the world. The fact is that one of the key factors in the breakdown of the social fabric of the United States was the end of the Soviet Union. That is not lamenting the end of the Soviet Union, which is one of the most evil forces in the history of the planet. What it is saying is that when countries do not recognize that there are other players on the world stage, they tend to turn inward and start tearing each other's guts out. So if the United States were to recognize China as the global enemy that it is, then presumably that would require some sort of common mobilization by the American people. That wouldn't necessarily be a bad thing.
An actual human family is built of multiple generations, and those generations pass down constraints. Everybody pressures everybody else. And it's good that people pressure other people, because if you don't have those pressures, then you don't get the benefit of the wisdom of older people who have more experience, which you get from the pressures to be free, but within limits that can help you.